Do you feel lost in the sea of financial jargon? Many aspiring investors struggle with a lack of knowledge and direction. Let Buffett's time-tested rules be your guiding light, giving you the clarity and confidence you need to navigate the world of investing. Rule number 1. Invest in what you understand. One of the cornerstones of Warren Buffett's investment philosophy is the principle of investing in what you understand. This rule emphasizes the importance of familiarity with the industries or companies you choose to invest in. A prime example of this is Buffett's early investment in Geico, the auto insurance company. In the 1950s, Buffett recognized the potential of Geico because he understood the insurance business and its fundamentals. He saw that Geico had a unique business model that allowed it to offer lower premiums while still being profitable. This insight led him to invest heavily in the company, which ultimately paid off handsomely as Geico grew and became a significant part of Berkshire Hathaway's portfolio. The value of knowledge and research cannot be overstated when it comes to making informed investment decisions. By focusing on industries or companies you are familiar with, you can better assess their potential for growth and understand the risks involved. This familiarity allows you to analyze financial statements, market trends, and competitive advantages more effectively. When you invest in what you know, you are more likely to stay engaged and informed, which can lead to better decision-making over time. Moreover, investing in industries you are passionate about can make the process more enjoyable and fulfilling. If you have a genuine interest in technology, healthcare, or consumer goods, for instance, you are likely to stay updated on the latest developments and trends within those sectors. This passion can translate into a deeper understanding of the companies you invest in, giving you an edge over other investors who may not have the same level of insight. Warren Buffett's rule to invest in what you understand encourages you to leverage your knowledge and interests when making investment choices. By focusing on familiar industries or companies, you can enhance your ability to make informed decisions and ultimately increase your chances of investment success. So, take a moment to reflect on your passions and expertise. This could be the keys to unlocking your investment potential. If you're enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start a financial journey. Rule number 2, think long-term. Warren Buffett's investment philosophy is deeply rooted in the significance of a long-term investment strategy. One of the most illustrative examples of this principle is his investment in CocaCola. In 1988, Buffett began purchasing shares of the beverage giant, believing in its strong brand and consistent demand. Despite market fluctuations and economic downturns over the years, Buffett held onto his CocaCola shares, demonstrating remarkable patience and confidence in the company's long-term potential. Today, Coca-Cola remains one of Berkshire Hathaway's most valuable investments, showcasing the power of a long-term perspective. The benefits of adopting a long-term investment strategy are manifold. First and foremost, it allows investors to ride out the inevitable ups and downs of the market. Short-term market fluctuations can be unpredictable and often driven by emotions, leading many investors to make hasty decisions based on fear or greed. However, by focusing on the long term, you can maintain your composure and avoid the pitfalls of reactive investing. This resilience is crucial as it enables you to stay committed to your investment thesis even when the market is volatile. Moreover, a long-term mindset encourages you to look beyond immediate gains and instead focus on the underlying value of your investments. Companies that demonstrate strong fundamentals and growth potential are more likely to reward patient investors over time. By resisting the temptation to chase quick profits, you can build a more stable and robust portfolio that stands the test of time. In a world where instant gratification is often the norm, adopting a long-term investment strategy can set you apart from the crowd. It requires discipline and a willingness to think differently about your financial goals. So, as you embark on your investment journey, remember Buffett's wisdom. Think long term. Embrace the power of patience and resilience, and you may find that your investments flourish in ways you never imagined. By focusing on the bigger picture, you can create a path to financial success that is both rewarding and sustainable. Rule number 3, diversify wisely. Diversification is a fundamental principle in investing, and Warren Buffett emphasizes its importance in building a resilient investment portfolio. While Buffett is known for his concentrated investments in companies he understands, he also recognizes the value of diversification to mitigate risk. His approach can be seen through the diverse holdings within Berkshire Hathaway, which spans various industries, including insurance, consumer goods, energy, and technology. For instance, Berkshire Hathaway owns significant stakes in companies like Apple, CocaCola, and American Express, showcasing a blend of sectors that helps balance the overall risk of the portfolio. The primary benefit of diversification is its ability to reduce risk. By spreading investments across different asset classes and industries, you can protect your portfolio from the adverse effects of a downturn in any single sector. For example, if the technology sector experiences a slump, having investments in consumer goods or healthcare can help cushion the blow. This strategy allows you to maximize potential returns while minimizing the impact of market volatility. Moreover, diversification can enhance your investment opportunities. Different sectors perform well at different times, and by having a balanced mix of assets, you increase your chances of capturing growth across various markets. This approach not only helps in managing risk, but also positions you to take advantage of emerging trends and opportunities as they arise. As you consider your own investment strategy, it's essential to think about how you can diversify wisely. This means not only investing in a variety of stocks, but also considering other asset classes such as bonds, real estate, or even commodities. A well-rounded portfolio can provide stability and growth potential, allowing you to weather market fluctuations more effectively. While Warren Buffett may advocate for concentrated investments in companies he believes in, he also understands the critical role of diversification in a successful investment strategy. By adopting a balanced mix of assets, you can reduce risk and enhance your potential for returns. So, take the time to evaluate your portfolio and ensure that it reflects a thoughtful approach to diversification. Your future self will thank you for it. If you want to know more about the path to prosperity, check out the video here and see you there.